Property is expected to fall. Let's have a look. Good afternoon, everyone. Florian.Heise here, and welcome to another episode of HeiseSays. I have my lunchtime stein of coffee, and I thought we'd have a look at this article from the Australian Financial Review. Well, two of them, really. The first one I'd like to start at looking is one regarding property prices and the expectation that they will fall up to 10%. Now, we've looked at other pieces in the last few days, and I've put it out to comment to many of you to say, how far do you think it's going to fall? Where do you think it will hit? Or what are you waiting for? What's your magic number? Some people are saying, wait for, offer 100 grand, less than everything. I'm waiting for 40%. I'm waiting for 50%. We'll have to see, guys. There's other spruikers out there saying that the Australian property market is so robust, it will help dull the blow to the Australian economy due to this pandemic that's ravaging the world. I find that quite funny, and funny and in some ways rather sad that people are believing that. We'll have to see. So let's have a look at this. Property prices are expected to fall by about 5 to 10% this year, with a significant risk they could plummet as much as 20% as the economic uncertainties around the pandemic escalate. Well, yeah. I mean, this is the thing. You can pull all these numbers out of thin air. 5%, 10%, 20%, 40%. If we look back at just property growth and the affordability, they are highly unaffordable with regards to the traditional ratio of wages to buying a house here in Australia. So you could make that argument that they've got a lot of room to move. But it comes also down to desperation. If people need to sell, how long can they hold on to it? People are emotionally attached to property, and they don't want to make a loss. So they may hold on to something longer and longer. They may hold the bag rather than taking a loss initially. But there'll come a time when people can't hold the bag much longer, and it'll start snowballing. We'll have to see, guys. But remember, property always goes up, written in alternate case. So it comes as the latest CoreLogic Home Value Index shows house price growth took a hit halfway through March as social distancing measures to reduce the number of virus infections ramped up and consumer sentiment slumped. Well, I mean, I don't know how many people actually trust the CoreLogic data out there at the moment, but I'm sure there's some. There'd have to be some. Property values, nevertheless, increased. Okay. Sure they did. Across most capital cities over the month, albeit with more subdued growth than in recent months. Now, I will bring up this chart here, everyone. This is showing you unit price growth across Sydney, and those in red have had negative growth, and those in green have had positive growth. It's not uniform. The problem is with CoreLogic and with the media and how they're reporting a lot of these things. They'll say, all of Sydney is increased by 5%, or this, or this, or this. You need to get to a more granular level to understand it. There's always going to be, even if the market crashes, there will always be some properties in some areas that are going to be more desirable to people. So, prices grew 1.1% in Sydney compared with 1.7% a month earlier. 0.4% in Melbourne, 0.6% in Brisbane, and Canberra, 0.5% in Perth, and 2% in Darwin. Values fell by 0.2% in Hobart. We have seen quite a slowdown in momentum, AMP Chief Economist Shane Oliver says. Unfortunately, from here, it's going to go downhill quite significantly. The debate is by how much. Mr. Oliver forecasts prices will fall by at least 5% in 2020, with a significant risk that they could fall by 20%. So Oliver's saying, or Shane, is saying a 5% fall in 2020. Seems, well, considering how drastic the impacts on the economy are, that seems like quite a small fall. I mean, didn't we have reductions in property values like that just last few years without completely shutting down the national economy, everyone? The things that will help limit price declines are that supply will dry up to a large degree, he said. Oh, well, so that's the argument. We've got the bank mortgage payment holiday for those who need it for 6 months. We've got wage subsidies, which will allow those who qualify to keep earning a salary. Well, the salary, $1,500 a fortnight, is that going to help them maintain their mortgages? But it depends how far to the hilt they are, how indebted they are. But still, you've got low interest rates, which is true, although that is not a big deal in this situation. All of these things help and will take the edge off massive price falls. Or will they delay it? Will they be 6 months before we start seeing cracks? And then another 6 months before it starts getting worse? Are we really talking about subdued property for the next 6 months and then, bam, a really hard hit at the end of this year? So, on the flip side, unemployment will still go up and it will take a long time to come down, well beyond the 6-month period through which the bank payment holiday and wage subsidies apply. Unemployment could still rise to between 7.5% and 10.5% this year, despite the Morrison government's $130 billion wage subsidy. Well, yes, I mean, that goes without saying, doesn't it? The latest unemployment figures are going to definitely be something interesting to watch. JP Morgan chief economist Sally Auld said a price fall in the order of 10% could be expected. So Sally's saying 10%, Shane's saying 5%. That would be a large unwind and big ramp up in house prices that we saw through the back half of last year and the first couple of months of this year, Miss Auld said. And then from there, it really depends on the duration of the downturn and the sort of recovery we have after it. So housing trends turn slowly, and we've seen this mentioned before. While the latest data showed national property value gains in March, there was a rapid deceleration in the rate of growth in the second half of the month. From about March 16th through to the end of March, the rate of growth virtually halved, said Tim Lawless, CoreLogic head of research. The point to make on the fact that values are still rising is that it is very rare to see housing markets trends turning extremely quickly, like equity markets do. They tend to be much more illiquid and have longer settlement periods and so forth. So that illiquidity is going to increase, I would say. Now, with just the ability to even sell stuff is going to be harder. Or even have an open house is going to be more difficult. Do you think people will adapt to remote auctions? Stephen Koukoulas, managing director at Market Economics, said the federal government's hefty stimulus measures, in particular the wage subsidy initiative, will help to put a floor under most parts of the economy, including the housing market. So the government is increasing its debt again in a way to help prop up the housing market, which is already unaffordable to most of the people in this civilization. Yay! Fantastic! You know, I'm sure the boomers will be happy. Even those people who are in financial stress won't be forced to have a panic sale and just take whatever price they can, which of course was one of the problems in the US of the GFC. People just selling their houses at any price compounded the problem. Nevertheless, he said a 5 to 10% drop was in the ballpark of what we might see as a decline in Australian-wide prices over the period of this crisis. Of course, if it lasts longer, the fall will be greater, he said. Certainly, the volume of activity will shrink massively. Sellers who don't need to sell probably will just wait or just withdraw their property from the markets, and buyers who don't urgently need to buy or are having financial concerns won't be stepping up, he said. The temporary nature of the crisis means that most home owners would try to weather the storm, hoping for an eventual upside once the virus is contained and economic conditions will improve. Capital growth trends will be contingent on how long it takes to contain the virus and whether additional constraints on businesses or personal activity are introduced. Well, I think we'll see more of that, guys. More constraints, more restrictions, more limitations. Leniency from the banks for borrowers facing financial hardship should help to stymie the number of distressed properties hitting the market. Similarly, he's talking about the job reduction or job retention and other government stimulus. So what do you think, guys? Do you think we'll see 5, 10, 20% reductions? Let me know your thoughts and opinions in the comments below. Please like, share, and subscribe to the channel. If you're a fan, you can support us via Patreon or YouTube. You can use our affiliate links at Amazon or eBay, or our referral links at Independent Reserve and Kucoin for the crypto traders. We have merch from Teespring or from our HeiseSays website. can pay us or donate via PayPal or send us gold via Gold Pass. Take care, guys, and I'll see you all next time. Bye for now.